Hey everybody, Jonathan Broadbent here, your host of UnWoke.Academy with another Wednesday live stream. We go live every Wednesday at noon to give you the opportunity to ask questions and join the conversation. We're talking about, of course, the same thing we've been talking about for years now, which is the undue, inappropriate, and misaligned far left positioning, the far left movement of our money. We all know that, or most everybody now can acknowledge that a lot of our tax dollars gets redirected into companies, causes, and countries that actually mean us harm, that work against us. That's been thoroughly disclosed and vetted and uncovered in all kinds of things like the CPA report showing the use of what are called offshore managers to get around trade embargoes and get US dollars invested in really bad things overseas, like the growth and expansion of the Chinese Communist Party's military. Yes, that's actually a thing, and it's actually happening inside of many people's 401k plan, IRA, etc. So I've been arguing this point from a number of different perspectives for a long time. I have many decades of experience in and working for, and then oftentimes countering Wall Street. I have a background working on Wall Street in institutional finance. Specifically, I worked on the administration of workplace retirement plans, things like 401k plans. And I've set up all kinds of systems like payroll integration, IRA contribution mechanisms, and all those kinds of things. But a big part of that is making sure if you have one of those little sign-up books for your 401k plan, and you check a couple of boxes for mutual funds, that those mutual funds make sense, that they're doing what they advertise. Pardon me, I'm so excited about this topic, I'm getting choked up. That they do as advertised and that they don't go off the rails and do horrible things. Well, I've proven in my book, and I'm waiting for somebody to come and argue that I missed something or that I'm wrong, that based on virtue signaling, went off the rails a long time ago. And the use of replacement terms like environmental, social, and governance, and diversity, equity, and inclusion, and sustainable those replaced common sense a long time ago and allowed the people who were supposed to be manning the fort and thoroughly vetting the options, the investment options that are made available to you, they missed the curve and went off the tracks a long time ago. And if this concept is new to you, I encourage you to go back and watch an episode that I did called Parade of Woke Sameness. What I did in that is took some of the largest mutual funds found inside 401k plans, according to a news source called Kiplinger, and just starting at the top with the largest, I worked my way down the list and show and actually turned into visual form that many of these investments, in spite of having very different sounding names, ended up investing your money in virtually the same way over and over again. In fact, there was one portfolio that was shared with me by an individual family where we lifted the hood on lots of funds, including an array of different Vanguard funds. I think there were some iShares, which was part of BlackRock. BlackRock actually owns iShares, in case you didn't know that, and showed that in spite of having these very different sounding names, and there were 40 some different funds, many of them, or most of them, ended up investing the money in almost the same way. Well, that's captured markets. That's the opposite of free market economy. And it's damaging, it's harmful. And I make an argument in a series of posts that I've done called The Globalist Bubble that it represents a significant harm and threat to the average investor. So if we have a huge mass of the population that's been put into lots of great sounding funds, and many of them for a while even had stuff in the title of the fund like sustainable fund. I think that's mostly evaporated now and it's mostly gone, but still I don't believe that the underlying investment strategy has changed all that much. Or, well, to be more complete, to give more of a complete answer, I believe that many of those fund managers out there who drank the Kool-Aid and figured, yay, we can make huge, easy money by no longer actually vetting what we're investing in and just put everybody into the same woke sounding, ESG, DEI companies, is that clearly happened. And they stopped having to do due diligence, which is actually expensive. You have to have boots on the ground and go out and look through the books and records of companies and figure out the profitability and their management structure and the research and development. That's all in my world, we call that stuff fundamentals. But if you don't have to actually evaluate a company, think like a CPA would do, or a business mergers and acquisitions and all those types of people, they're very adept at drilling down and getting into the minutia of company figures. When they say that they made $10 billion of profit last year, then what do they have to show that for that? What are the underpinnings of? That's fundamentals. And that forever in the stock market, in all stock markets, is how people chose to invest your money. They would go out and do the research and run a mutual fund or whatever, exchange traded fund, whatever investment vehicle. They would choose to invest your money based on the results of their research. And when the whole ESG, DEI, sustainable stuff showed up, it gave this easy button free pass to money managers to effectively say, we don't want to do that anymore. We don't want to go out and look at companies and evaluate. It's much easier to just give a small number of companies that check all those boxes and claim on a very public international scale to be diverse and to have sustainability goals and all that stuff. Meanwhile, everyone's still struggling to try and actually define it. But they made these big, bold claims and said, we got it. We check all these boxes. So therefore, BlackRock, Vanguard, State Street, lots of other types of money managers, come bring all your money, invest huge, huge trillions of dollars in these small number of companies because they check those virtue signaling boxes. And I am still watching the lawsuits that are now just finally starting to really come to the surface of smart people who actually are calling out and claiming they're blowing the whistle that the emperor has no clothes. If you can go years and years by saying that this company and this investment is ESG and DEI or whatever, and you still haven't actually defined it, I got to call the bluff and say, I think you made it up. And I think that that doesn't actually exist. It gave an excuse for a small number of companies to get too much money and become overvalued. I'm not the only one saying that. There are lots of people, economists and otherwise, who are calling the bluff. That are pointing out that a handful of these companies, big globalist companies, and you know the clique, you know the cabal, you hear their names all the time. It's NVIDIA, Apple, Microsoft, Amazon, a bunch of the pharmaceutical companies. They got so much money, they didn't know what to do with it. But the downside during that era has been the crushing of competition. It really just about virtually destroyed any potential for any new startup, small, mid-size, or even large company, or very large, to compete. So many of them, they can't compete with a company that has trillions of dollars. You could be a $10 billion company and just get crushed in that environment when you have a competitor who can outmaneuver on every patent, on every research and development, that has deep connections, according to a lot of the research that I've done with politicians who create the legislation that impact those areas of business. So then virtually everything can and was being driven into extinction. No funding, no access to capital, overregulation, and all kinds of bad stuff happening that allowed those 30-ish companies to just absorb the markets, basically. So unsuspecting people out there, and that might be you, and don't blame yourself if it is, when you get your 401k statement or your IRA booklet or whatever, or you meet with your financial planner or advisor, and they say, look at this, how great. You have these 25 different mutual funds or 10 or whatever it is. Look under the hood. I've shown in prior episodes how easy it is using any browser, even on your smartphone, to figure out what those funds are actually investing in. So if those mutual funds are taking those 10 that you're invested in or whatever it is, and if you lift the hood and see that many of them are virtually identical duplicates of each other, you're not nearly as diversified as you think you are. That's where that bubble concept comes in. Well, there's good news. The good news has been building for over a year now. It was actually early 2024, we started taking the research that we've done at UnWoke.Academy and talking a lot about the companies that are successfully fighting back, that were gaining some capital, gaining some ground, and didn't go woke. The companies out there that are publicly traded, which means that you can go out there and buy and sell shares in these companies, that didn't, according to all of our research, they didn't go woke. They didn't start putting out there all kinds of propaganda that they were sustainable as a company, that they were diversity, equity, and inclusion and all that. These are companies that said, we have a good product or service, and we have good people, and we manage it well, and we're profitable. That's really kind of at its core, that's the mission. And that's the statement that many of these companies were making. So we started tracking them. And then when people started asking, and we had a hard time finding fund managers that didn't go woke, we started talking, encouraging people to go back to what we know works. If you want transparent and you want to know what you own and feel confident and comfortable in the portfolio, in your investments, go back to what works. Build a stock portfolio. It used to be back in the 80s, 90s, that was complicated. It was expensive. You had big commissions to pay to stockbrokers and all that stuff. That's no longer the case. It's actually very easy. It's easy to do, even inside of a 401k plan. You can get, it may take a couple of questions from your human resources office or your CFO or your company, their benefits director or whoever. You can quite potentially add something called self-directed brokerage inside your 401k. And that gives you the option. Lots of people have it. It's not as mainstream as everybody sort of dumping their money into mutual funds, but you can own individual stocks inside your 401k plan. Tax sheltered, it's a beautiful thing. And unlike the 70s and 80s and 90s and all that stuff, the commissions are so low because of the volume of trading that happens and competition over those trading apps on your phone and stuff. It's really, I mean, it's very close to free. It's certainly not free. There are going to be commissions. You pay a couple of bucks here and there, but compare that to any advisor fees on top of any investment management fees, and those are subtracted no matter what on pretty much everything. If you have an exchange traded fund or mutual fund or whatever, that's that fee that gets siphoned off. It's eroding the value. It's eroding the performance of whatever you're invested in. So if you've ended up where a lot of other people have, which is checking a bunch of boxes on a series of mutual funds and thinking that you're properly diversified, take that first step of figuring out what it actually costs you. And that's easy. Look up the fund and it will tell you in any web search, it may be 0.5% or 1% or something. So figure out how much money you've got invested. If it could be hundreds or thousands of dollars that are being subtracted out of your account that don't have to be. If you make the switch, and this is just a little easy comparative math. We've got lots of people who've run, actually through the years, we've run a good number of examples showing side by side. The person who has an IRA account and a 401k and a Roth IRA, and they're paying $5,000, $7,000 a year and all kinds of fees and management fees, etc., and then switch and just simply build a long-term portfolio of stocks, an investment portfolio of stocks. Instantly, they see what they own. The whole issue of hidden votes, that's a side topic. Go back and watch the episodes on proxy voting and how a lot of the voting that happens connected with your investing happens shifting ever further to the left. It's harmful and bad. But you get all of that, you see all of that, and then quite often, and it's easy to do, even just some back of the napkin rough sketch with math, how much are you currently paying in fees that are hidden, or moderately hidden? You can figure those out fairly easily. And then how much would it cost you every once in a while to build that stock portfolio? Virtually every example I've ever seen comes out significantly in your favor. So that's just a win-win all the way around. As promised, the results of that, I share this periodically. The financial PMA was born out of UnWoke.Academy. We have all this research into finding the companies that aren't woke, tracking them, reporting on them, and in early 2024, we started encouraging people on wherever you are, wherever you like to do your investing, build stock portfolios. I'm going to pause and interject for anybody that doesn't know. Ultimately, if you're buying a mutual fund, that's pretty much what you're getting anyway. They may have a mix of a few other things in addition to stocks, but the overwhelming majority of mutual funds out there, that's all they're doing is you're paying them a fee to build a stock portfolio for you. You don't have to pay that fee. You could build it on your own, and it gives you all those things that I just mentioned. The transparency, probably lower cost of ownership, and you gain that the voting, if you want to do the voting connected with that. So on October 8th of 2024, I personally was involved in helping somebody make some trades on their account based on our research. That one, I'm pleased to report, as of close of markets yesterday, is up 61.53%. That's unrealized gains from October 8th of 2024. So just a little over a year. In a little over a year, they've gained 61.53%. I believe that's not so much some magical, mythical sort of stock picking phenomenon. I know a lot of people that work in finance will make those sorts of claims that they have this great magic wand, crystal ball kind of thing, and that they're going to do this great stock picking. Really, what that is building a diverse, good foundational portfolio based on stocks that we can see. That's all it is. It's a series of companies. The investor sees these. The trading was actually very nominal. And since then, she's had almost no cost. There's no advisory fee. There's no management fee. It's virtually, cost is evaporated and disappeared from that. What that is, instead of going down the far left woke-a-doodle path of defaulting into whatever mutual funds are served up by whoever it is that is working on your 401k or making recommendations on your IRA, and maybe just allowing themselves to follow the bouncing ball into the far left woke mutual funds. What that is, I firmly believe, is the reopening of capital markets. That is free markets reinvigorating after years of mass consolidation. So put that all together, and it means that a lot of those people out there they've defaulted into a small series of mutual funds that are your usual rank and file, ultra large mega fund that drank the Kool-Aid and followed the bouncing ball and went into that small number of overfunded, overcapitalized companies. I believe that they are in danger. I believe that there is significant danger to those. And I believe that as the markets have reopened, and capital just means money, the access to getting money to feed your business and continue to grow and flourish, capital markets reopened, and that's the result. We got huge growth among all the companies they were cash starved for years. They could hardly get access to any money. Well, now they're getting money. If you know people, or if you're one who ended up in the next time you get your 401k statement, well, two things on the 401k statement. Look at the mix of investments and make sure that it's what you think it is. It probably isn't. Based on statistics and all the research that we've done, you may actually be far less diversified than you think you are. It's easy to do with any browser to lift the hood and see what you're being invested in. And connected to that, figure out what it's costing you, and then do a side-by-side. Visit thefinancialpma.com or send a message to me, Jonathan, at UnWoke.Investing.com, and we'll try to get your questions answered. Everything that I've put out there all uses publicly available information, sites like Morningstar.com. In a couple of mouse clicks for free, you can easily make a determination if these conversations apply to you. And it's pretty easy to chart a path into something better. Hopefully, saving you a lot of money, growing a lot of money, and avoiding that globalist bubble. We have extended the conversation that I had last year in the fourth quarter for 401k plans. That's my background. That's what got me recruited onto Wall Street. I am delighted to go and help companies in the administration of their 401k plan. However, I have since 2009 done that very differently. That's when I left Wall Street. I didn't like what I was seeing. Plus, there was kind of a dust up on Wall Street when I wrote it was a long 3-page letter admonishing Wall Street for the behavior of funneling money into a company called BlackRock. I believe that they were artificially, I'm confident that they were artificially steering trillions of dollars, billions and trillions into BlackRock without proper vetting and due diligence. So anyway, the combination of circumstances there, it wasn't for me. I left Wall Street in 2009. For any companies out there that offer 401k plan or something like it, I'd love to have a conversation because it gives me opportunity to bring this whole conversation around what's actually happening in the mutual funds in the 401k plan and bring in all of my decades of training. I've trained across the country on all the way up to state level on the administration of those types of plans. I bring that on a much more transparent level and love the chance to talk about it. If you're an industry professional, if you work in finance or have a family member or friend who does, steer them to this conversation because we need more people willing to pick up the mantle of this conversation and talk about what's really happening in the world of finance. We can't afford many more years of our money being artificially redirected into far left companies, causes, and countries. We should be seriously talking about exactly what was published on February 21st of last year, 2025, when President Trump released his America First investment policy. The more we do that and shift back to free markets, the more we can grow our economy, America's middle class, and get back to what America could and should be. This has been another weekly Wednesday live stream with UnWoke.Academy and the Financial PMA with me, Jonathan Broadbent. Thanks for tuning in.